I'm Alice Abreu, and I am the chair of the tax section. Welcome to the plenary session of the May meeting. In my day job, I'm a law professor at Temple, but it has been a real honor for me to have served as the chair of the tax section since August of this year. So I hope everyone has had a great meeting. We're so pleased to have so many of you attending this meeting. We have over 1,800 people in attendance. So, yes. I want to start my remarks today by thanking our sponsors for making this meeting possible. Your support is invaluable. You can see them on the slides. They are our diamond sponsors are Kaplan and Drysdale, Hayes and Boone LLP, Castellanos, Tax Analysts, and Winthrop and Weinstein. So thank you very much. And I also want to thank our Ruby and Emerald sponsors which are listed on the screen right now. I also want to recognize Thomson Reuters and the educational affiliate of the tax lawyer, Northwestern Graduate Tax Program, for their long-term support of the tax section. I would now like to acknowledge some special guests, but please hold your applause until I'm done and we can then acknowledge them as a group. We are thrilled to have 3 classes of Loretta Collins Graetz Fellows with us today. You can see their names, the names of the most recent class on the screen, and we are accepting applications for the 4th class, and the application due date is May 31st. So our Graetz Fellowship is a 3-year fellowship which covers section meeting registration, lodging, and travel, as well as membership in the ABA and the tax section. So get your applications in and help us spread the word about this wonderful program. I would also like to recognize our Christine Brunswick Fellows. These are recent law graduates who are working in nonprofit organizations focusing on public interest law in tax. For 2 years, Hannah and Mohit will continue their fellowship this summer, and we will welcome 2 new fellows in September. We're very grateful for their hard and very important work. I would also like to welcome our tax analysts, public service fellows, RG and Leslie. And this fellowship is similar to the Brunswick Fellowship, but it is geared toward more experienced practitioners, and the applications for that fellowship are due May 15th. More information and applications are on our website. We are also thrilled to launch our a new fellowship, also in collaboration with tax analysts. The Tax Analyst Summer Fellowship will allow 2 law students to work with low-income tax clinics for 10 weeks during the summer to promote the pipeline of future public interest lawyers. We look forward to hearing about Juan and Caitlin's work. Finally, I would like to welcome the 2024-2025 class of John S. Nolan Fellows, whose names you can see and pictures you can see on the screen now. And also to congratulate the 2025-26 class of Nolan Fellows who will start in the fall. The Nolan Fellowship recognizes up-and-coming tax section leaders. And this year, the selection committee chose these 6 outstanding contributors to our section's work. They are Ira Agai, Sarah Green, Candace James, James Steele, Sabrina Strand, and Scott Woody. And now, all of the fellows who are with us today, please stand and we can all thank them with a round of applause. Thank you so much to the fellows and also to those of you, our members, who are making this happen by your contributions to the TAPS and the JEDI Fund. It is so wonderful. This is the future of the organization. So thank you, fellows. Thank you, members. And none of what we do and our ability to gather together like this is possible without our outstanding tax section staff. They work in the background, but they are what makes all of this possible. So I want to thank them for their hard work and dedication to our programs and services. I'm really grateful, and please join me in giving them a round of applause. So I want to ensure that our upcoming meetings are on your calendars. Our 2025 virtual fall tax meeting will be October 20th to 24, and we will have, again, an in-person mid-year meeting, this time in San Diego, California, on January 15 to 17, 2026. And this coming mid-year meeting will be back to our more usual Thursday through Saturday pattern as this meeting is. We were pleased with the response to the new track programming that we instituted at the mid-year meeting in LA, and we plan to continue the track programming, although of course we've now learned things and we will make appropriate tweaks and adjustments. Finally, before we move on to our awards and keynote, I want to acknowledge the challenges of the time we are living in. It's challenging for lawyers and for the rule of law, for tax professionals, and for the tax system. The ABA tax section's mission is not only to provide education, but also to support an equitable, efficient, and workable tax system. We face immense uncertainty in advising clients and others on how to best comply with the tax laws, and we worry about the strength of our institutions to provide guidance, ensure proper administration and compliance, and to apply the laws in an equitable manner. The American Bar Association has been the subject of numerous attacks by the current administration and has responded by standing firm on its principles of respect for the rule of law, the independence of judges and lawyers, and the importance of creating and supporting a diverse and inclusive bar. I am very proud of the ABA's strong response, despite the fact that it has led or cost to the loss of $70 million in federal funding and the laying off of over 300 employees. The ABA is fighting, continues to fight, as is the section. We have faced challenges in the past, most recently during the pandemic. We came together then and we weathered the storm, and I am certain that we will do so again now. Fortunately, we have a very strong team of leaders and staff. For me, the silver lining of the current cloud is the ability to work with really smart, dedicated people, all of whom feel as deeply about the values of the tax section, the integrity of the tax system, and tax administration, as I do. I hope this meeting has given you a chance to receive comfort and validation. Please know that the leadership and staff of the tax section and the ABA are committed to upholding our mission, and we want to hear from you on how best to use our collective words. I am easy to find. My email is my last name, abreu@temple.edu, and if you email me, I will respond. If I don't respond, it may mean that it went into my spam box, so email me again. I really mean it. We, the tax section, the leadership of the tax section, wants to hear from our members on both what we could do effectively for you and for the tax system. But now, in happier news, the tax section continues to build on our robust public service offerings with a new program. We partnered with the Alaska Business Development Center to send 6 tax section members to remote villages in Alaska in February. They completed 380 tax returns, and we are very excited about this unique volunteer opportunity, and we will be opening applications for 2026 volunteers in the fall. You can read more about it in the new iteration of ABA Tax Times, which is coming to your inboxes soon. So, on to the awards. I have the honor of presenting the 2025 Janet Spragens Pro Bono Award. This award was established in 2002 to recognize one or more individuals or organizations for outstanding and sustained achievements in pro bono activities in tax. This year, the committee selected a group rather than an individual for the award. Founded in 2019 by tax section member Chuck Hodges, along with CPA James Freeman, both of Atlanta, Georgia. The organization is Filing for Freedom, and it is a 501c3 nonprofit organization that provides free tax preparation services for military personnel and first responders who sacrifice so much for all of us in their communities. Chuck and James originally started the organization inspired by a powerful speech to the Atlanta community by then Commissioner Chuck Rettig, whose son serves in the military. Tax return preparers who were taking advantage of military personnel and charging excessive fees is what Chuck Rettig talked about, and knowing that the military personnel needed their refunds quickly, especially those going overseas. And Chuck challenged the tax community to do something with our talents to help those military families. This year's award recipients quickly mobilized their extensive networks through local bar and CPA associations and partnered with the IRS, the Department of Defense, and the Atlanta Police Foundation. They also garnered the support of corporate sponsors like the Atlanta Braves, Coca-Cola, and Chick-fil-A to ensure that their financial needs were met for the long run. Filing for Freedom began in its operations at Dobbins Air Force Base and quickly expanded to in-person services to first responders. After operating for several seasons, they broadened their operations to provide virtual tax filing assistance to several bases spanning several states and branches of the military. Each year, they recruit and train their volunteers, which are made up of CPAs, attorneys, and others, who certify through the IRS's Volunteer Income Tax Assistance Program, VITA. And Chuck Hodges says that volunteers, of course, are the heart of their program. They are professional, dedicated, and willing to not only give their time, but their knowledge and expertise so that they can provide free tax preparation services to military personnel and first responders. To date, military families have collected in excess of $1 million in refunds thanks to Filing for Freedom return filings. So it is now my honor to present the 2025 Janet Spragens Pro Bono Award to Filing for Freedom. Fortunately, longtime section member and co-founder of Filing for Freedom, Chuck Hodges, is here to receive the award. So Unfortunately, James Freeman could not be here, but Chuck will receive the award on behalf of the entire Filing for Freedom team. So Chuck, can you come up and get the award? And I am now going to get out of the way so Chuck can say a few words.
I'm not really good at saying only a few words, but we'll try. 2019, Chuck Rettig did, as it was just shared, came to Atlanta, and after giving this powerful speech, said, hey, do something for the military, whether it be buying their Starbucks if they're in front of you or just saying thank you when you're in the airport, but do something. Then after that meeting, as the chair of the Atlanta Bar, people said, we got to do something. And I was like, what? And they're like, you figure it out. And so of course I immediately thought, I'm like, okay, maybe we could do a tank car wash. I was going through all these things. But then I looked it up. And the two things that military families that scare them the most, wills and taxes. Okay, I can't prepare my own will, so it wasn't going to be helpful there, but I did help them get to that. But then it's taxes. So then in a collaboration with the Georgia Society of CPAs, Filing for Freedom was born. And so, but I didn't know what I was biting off. All of a sudden, we needed a place at Dobbins Air Force Base. We needed security clearance. I needed volunteers in Atlanta, Georgia, on spring Saturdays when everybody's kids are playing baseball and soccer. And so we started that first weekend in February of 2019. And I remember going in after looking at how many hours I had to spend to just have that day, and 10 people for the military signed up. And so I thought, have I created a solution to a problem that maybe doesn't exist? And so I was like, but that's okay. We'll do it for this weekend, and then I'll move on. And then Jonathan came in. Who's Jonathan? Jonathan's a 21-year-old reservist. He's in the reserves at Dobbins. And he came in, and because Jones Day provided all the equipment, I had the printer. And so I was the reviewer. One person prepares a return, one person reviews it. And I reviewed the return, and I looked at Jonathan, this 21-year-old kid, and I said, gosh, $1,600 refund. That's great, Jonathan. And he looked back at me and goes, yeah, that's what that person said over there, prepared this form. I don't want that. And I thought maybe he meant I don't want it directly deposited. And so I was like, well, they can send it to you in a check. And he goes, and he starts getting up, he goes, no, sir, I don't want that. And then I realized what was going on. Jonathan knew nothing about our tax system. So I took he was like, my mom always told me that as long as I got one of these forms, which was a W-2, I didn't have to do anything else for taxes. And so I walked him through each item in his W-2 to where he then understood it. And then I said, Jonathan, have you ever, and he, by the way, he was a busboy at a very prominent restaurant in Atlanta. So he actually did pretty well. I said, Jonathan, have you ever filed a tax return? He said, no. So I contacted the IRS, who has just been amazing help. And I said, can I file his prior returns? And she said, yes. And so we filed 2 more returns. And so then he came in the next month. And then instead of 10 people, he had gotten the word out. We had 30 people. But he came back that next month, and I showed him, and he was due over $5,000 in refunds plus interest over the last 3 years. Well, then he started crying. Well, I'm used to my clients crying because of the result they got in their case. But this one, he was crying, and I go, Jonathan, wait, there's no crying in tax preparation. I mean, there's just not. And so he said, well, I support my whole family, and we only have 1 car. And this is going to allow us to have another car. And so then I realized that we were really helping these families understand taxes, the basic tax concepts, They're easy for everybody in this room. But it terrifies those people who protect you and protect me. So please get out there and do this. We have the way to do it, because I will tell you, once you start, then all of a sudden we said, hey, we should get t-shirts. We were getting phone calls from sponsors. This is our t-shirt. These are our sponsors. So our sponsors, guess who made the t-shirt? The Zach Brown Band. So then we got it our first year, and I got a very tough call from the Department of Defense that said, hey, we saw your t-shirt. Why isn't our logo on there? I go, wait, what? And then the IRS said, wait, you have to put our logo on there too. Tell me a t-shirt you've seen with the logo of the Department of Defense and the IRS. So at the end of the day, we have, for these people, we've collected over $1 million in refunds. We have done well in excess of 600 returns. And we're going to keep going, and we've expanded, and we'd love to expand to yours. It's been the most rewarding thing I've ever done. Thank y'all.
Well, thank you, Chuck, and thank you, tax section. Hearing stories like this makes me so proud to be a tax section member, and so happy that I am a tax lawyer. You know, a lot of people think tax is law for the rich, and only the rich have tax problems. But you all know that that's not true. We know that that's not true, and I think you should all give yourselves a round of applause for being members of an organization that commemorates this kind of work and that allows this kind of work to go on. So thank you. Of course, thanks to section member Chuck Rettig for having been such an inspiration. And now it is, I have another great pleasure and honor because we have a second award, the Distinguished Service Award. The Distinguished Service Award is the highest honor awarded by the tax section. The award is reserved for individuals who have had a distinguished career in taxation and who have provided an aspirational standard for all tax lawyers to emulate. It is my honor and pleasure to recognize our 2025 Distinguished Service Award recipient, Eric Solomon. You have a detailed summary of Eric's career at your table, but I would like to mention a few of the highlights before recognizing him and inviting him up to address you and provide some remarks. Eric was raised in Princeton, New Jersey, by parents who instilled in him a love of learning and a belief in the value of an education as a source of opportunity. Eric studied classics at Princeton University and earned his JD from the University of Virginia and his LLM from NYU. After working in private practice in New York and as a partner at Drinker, Biddle & Reith in Philadelphia, Eric assumed the role of Assistant Chief Counsel Corporate at the IRS, later joining Ernst & Young. Eric as a principal advising on M&A, but the call of government service led him back to the Treasury Department in 1999, where he served for a decade under the Clinton and Bush administrations, concluding his tenure as Assistant Treasury Secretary for Tax Policy. After leaving Treasury, Eric returned to EY to co-lead the National Tax Office. Subsequently, he became a partner at Steptoe & Johnson here in DC, and then at Ivins, Phillips & Barker, where he still continues to practice. Eric's tenure at Treasury was marked by government effort to curb the proliferation of tax shelters and measures to address the 2008 financial crisis. Eric was a leading member of a team that developed a system, including legislative proposals, regulations, and listing notices to help the IRS combat the tax shelter problem. and to deter users and promoters of tax shelters and identify returns requiring audit. Eric also served a key role in reforming Circular 230. The combination of clear standards and aspirational principles provoked changes in tax practice that have helped sustain the tax system despite increasing complexity and reduced resources for administration. In addition to serving as the ABA's tax section chair from 2018 to 2019, Eric served as a member of the executive committee of the tax section of the New York State Bar Association, the president of the American Tax Policy Institute, and co-chair of the Practicing Law Institute and the DC Bar Conferences. Eric's career also includes 30 years teaching corporate tax at Georgetown, where he has strived to guide hundreds of students through the complexities of Subchapter C. Eric's lasting contributions to the tax system and to the tax profession make it my immense pleasure and honor to recognize him with the tax section's highest honor, the Distinguished Service Award, for his contributions to the profession, the tax section, and now my great pleasure to welcome Eric and to hear his remarks.
Thank you, Alice, and thank you to the ABA tax section for bestowing this great honor on me. I'm sorry my wife Amy and my daughter Sarah couldn't be here today. Amy was a nursery school teacher for 20 years where every day she displayed her endless cheerfulness and patience. I'm also sorry that my mother and father couldn't be here today. Like Amy, both my parents were educators. My mother taught 7th grade English and my father worked for a nonprofit educational organization. And as Alice pointed out, they believe that education and the opportunity it provides are essential to success for each and every individual. And they also emphasize the importance of personal integrity. But I very much would have liked my father to be here today. My mother, in a somewhat charitable way, would describe my father as headstrong. And with that observation in mind, I'm going to tell you a little tax story about my father. Some of you may have heard this story, but I like repeating it. For several years, I prepared my parents' tax returns. And about 20 years ago, we were sitting at the dining room table, and all the papers were spread out on the table. And we got through the Form 1040, and my father was relieved that we were done. And I said, Dad, I'm sorry, but we're not done. We have to fill out this Form 6251 for alternative minimum tax. My parents lived in New Jersey. It was a high tax state, still is a high tax state, and it was likely that they owed AMT. So I said, Dad, we're not done. We got to fill out this form. He said, I'm 80 years old. I don't pay the AMT. And he swore he was not going to pay it. And I said, Dad, there is no exemption for 80-year-olds. And when I said that, he exploded. I told him it wasn't optional, and he had lost his temper, and he said, you're fired. I said, wait a minute, I'm your son, you can't fire me. You want to bet? And he fired me, and he filed his return without the 6251, and the IRS caught him and sent him a bill for AMT. And being a good son, I didn't say, Dad, I told you so. But it would have been really nice for my parents to be here today to show that I turned out okay, and to demonstrate that it's possible to make a successful comeback after you've been fired. Anyway, if you were to ask me what I'm most proud of in my career, it was my 15 years in government service at the IRS and then in Treasury's Office of Tax Policy. And if you were to ask me what I did in government service that was most interesting or most challenging, I think I would note 3 things. First, as Alice mentioned about tax shelters, I was a part of a team that was led by Assistant Secretaries John Talisman, Mark Weinberger, and Pam Olson. that addressed tax shelters in the late 1990s and 2000s. Tax shelters threatened to corrode the foundation of our tax system. We worked closely with the IRS in various areas in addressing tax shelters, including disclosure regulations, listing notices, and revisions to Circular 230. Second, I led the Office of Tax Policy during the financial crisis in 2008, where we had to address numerous difficult and novel tax issues on a moment's notice. And many of these issues rose as a result of urgent Treasury and Federal Reserve measures taken to halt the downward financial spiral. And third, in the mid-2000s, we were approached by the Department of Homeland Security. They had an initiative to seek taxpayer information from the IRS regarding undocumented aliens. And we objected to this initiative on both statutory and policy grounds. With respect to my years in private practice, I would mention two matters. First, under the leadership of Chair Karen Hawkins, we focused on inclusiveness in the tax section to expand membership and to increase opportunities to participate in tax section projects. Second, I'm proud of my role as a professor, an adjunct professor at Georgetown University, which I've now done for 30 years. This was my 30th year, and I've strived to teach the intricacies of corporate taxation in an understandable manner. In closing my remarks, I feel constrained to say a few words about our current national situation. We often take for granted the goods and services that our government provides, and these expenditures, which include national defense and social programs, are essential to our country's stability and prosperity. And these expenditures directly or indirectly help all Americans, rich and poor. We have difficult decisions to make about the level of government spending in this country. In addition, we must address our national debt. Either our generation must control the debt, or our children and grandchildren will bear the cost. We cannot afford to pass this increasingly heavy burden on to them. The potential economic and social consequences are too great. As Oliver Wendell Holmes said, taxes are the price we pay for a civilized society. The IRS plays a critical role in collecting nearly all the revenues that fund our public expenditures. In addition, the IRS has been given the responsibility to administer numerous programs, such as family benefits and energy initiatives. We need an effective and efficient IRS. We need an IRS that can provide taxpayer services so that citizens can understand their rights and obligations. We need an IRS that can ensure compliance with the law so that the government collects amounts properly owed and taxpayers believe that the system is fair. We need an IRS that has up-to-date technology so that it can operate effectively in the 21st century. Finally, we need an IRS where employees are treated with respect, to whom we should express our gratitude for their public service. I make these points as neither a Democrat nor as a Republican, as I served as a political appointee in both the Clinton and George W. Bush administrations. Instead, I make these points as an ordinary citizen, worried about the future of our country. Thank you for providing me a few minutes to briefly reflect upon who I am, what I have done, and what I believe. I would again like to thank the ABA Tax Section for bestowing this great honor on me. I am truly grateful for the recognition. Thank you very much.
Thank you, Eric, for everything you have done, and I know you will continue to do for the tax system and the tax section and the people of the United States. Thank you. And so now I would like to recognize our the sections, committee leaders and speakers and leadership council for your tremendous work in putting together informative CLE panels, business meetings, and networking events over the last 2 days. Thank you for all your hard work. I would especially like to thank our outgoing committee chairs who will complete their terms next month. These leaders have dedicated a tremendous amount of their time and talents to the tax section and have built vibrant communities within their areas of tax expertise. Your commitment is deeply appreciated, and we hope that you will continue your involvement with the tax section, passing on your knowledge and experience and mentoring those who follow you. This year, we also have several officers and council directors completing their terms. As chair of the section, I could not have performed my duties without a strong team on council. These individuals have guided the section through challenging situations, come up with innovative ways to move the section into the future, all with humor, joy, and patience. Your collective wisdom and talents are appreciated and will definitely be missed. I am now going to introduce those leaders, but I ask you to hold your applause until I am done. You see their pictures on the slide. So first, the officers. Professor Tony Infante, who is Vice Chair of Pro Bono and Outreach, officially until August. The council directors, Elizabeth Stevens, Mary Slonina, Bela Unel, Stephanie Lipinski-Galland, and Ali Petrova. We are fortunate that Ali has agreed to serve for another term now that she is completing a one-year term that she graciously agreed to step in and fill. I would also like to thank Lani Villalobos for her 2 years as secretary, and Morgan Klinsing for her 2 years as assistant secretary. Lani now moves on to a council director position, and Morgan will now become secretary. And I was looking for you over there.
Hi, I am Megan Brackney, chair-elect of the section, and it is my honor to be able to recognize Alice as this is her last in-person meeting as chair. It's been so much fun this last year getting to know Alice. As you're finding out, if you haven't already known, she's very passionate about tax education, and the tax section, and I think that comes through in everything she does. Her year has been a challenging year, full of fires, both literal and figurative fires, and she has gotten through all of them and brought the tax section through with her signature elegance and grace, and I'm very honored to have worked with her. There's always jokes about filling people's shoes, and it's kind of played out, right? Like I don't know how I'm gonna fill these shoes, it's a standard, but I can't not mention it this time because Alice, one of the things that we all know and love about her are her beautiful, elegant, tiny little feet and her amazing, fashionable, high-heeled shoes that you hear tip-tapping along the hall as she is moving quickly from one section event to another. I am not going to be able to fill those shoes with my big flat feet, but so I won't even go into that. I will just hand Alice her plaque, and I'd like you all to join me in thanking her for her year of service to the tax section.
Thank you so much, Megan, and thank you to the entire leadership team. We will be in excellent hands and big flat feet with Megan, who will follow me in August. And after Megan, it is wonderful to know that we will have Lisa Zarlenga, who will follow Megan, and that we are in excellent, excellent hands. The tax section is and will remain strong. So now on to the final thing in the agenda, which I know we have all been waiting for, our keynote panel. So Michael and Loren, I will now introduce them as they make their way up to the podium. So I'm delighted to introduce Professor Michael Graetz and Loren Ponds. Professor Graetz is the Isidore and Seville Sulzbacher Professor of Law and Columbia Alumni Professor of Tax Law at Columbia University, as well as Professor of Law Emeritus at the Yale Law School. And Loren Ponds, who is a tax partner at Skadden here in DC, specializing in international tax. Both are experienced and accomplished tax lawyers, and if I gave them the full introduction that they both deserve, they would have no time to speak, so I am not going to do that. I'll just hit some highlights. So in addition to being a law professor at UVA before going to Yale, Michael served as assistant to the secretary and special counsel at the Treasury Department during the administration of President Bush 41, that is Bush the Elder, having previously served as Treasury Deputy Assistant Secretary for Tax Policy. The most recent of his 11 books is The Power to Destroy: How the Anti-Tax Movement Hijacked America. He has also published many articles on a wide range of tax, political science, and related subjects. He has received numerous awards, including the Treasury Medal, the Daniel M. Holland Medal from the National Tax Association, and has been a Guggenheim Memorial Fellow. But he also received an award from Esquire magazine for courses and work in connection with the provision of shelter for the unhoused. Michael also served in a number of other capacities in IRS and the Commissioner's Advisory Group, but as I said, if I listed everything that he has done, he wouldn't have time to speak, so I am now going to go on and say a few words about Loren's background. Loren has also had a varied and career spanning a range of practice venues. Before becoming a partner at Skadden, she was a partner at Miller and Chevalier, and also here in DC, where she co-led its tax policy practice. She has also worked on the Hill as majority tax counsel to the U.S. House of Representatives, where she developed, analyzed, and refined the international tax provisions of the Tax Cuts and Jobs Act of 2017. Earlier in her career, she worked at a global accounting firm in Washington, D.C. and Dusseldorf, in their Washington and Dusseldorf offices, focusing on transfer pricing and tax controversy. She is fluent in English, French, and German, and worked as a trainee in the OECD's office in Paris, as well as serving as a fellow of the Alexander von Humboldt Foundation at the University of Hamburg in the International Tax Institute. And now, Michael and Loren are going to discuss Michael's recent article, which was published in Tax Notes earlier this year. It is titled Sovereignty, Sins, and the Reassertion of Primary Taxing Rights by the United States. And if you haven't read it yet, it is part of your meeting materials, so you can easily access it. It makes wonderful reading as you go back home or later this week. So with that, I'm going to turn things over to Michael and Loren, and you take it away. Thank you very much.
Okay. Thank you, Alice. Thank you, everyone. We are really excited to be here and looking forward to what proves to be lively discussion of Professor Graetz's paper. Understanding that many in the audience probably will not have read the article yet, we're going to start with an introduction. So Michael, maybe you can give us a few words as a way of background.
Yeah, I should begin by saying that I'm used to standing at podiums, and the idea of a fireside chat about international tax issues is sort of new to me. But that's the way Alice wanted to do it, and we do whatever Alice wants. And it's also a particular pleasure to follow Eric, who I've known for a very long time, and a fellow Atlantan who is always hard to follow Atlanta speakers, but I really appreciate what you're doing. But as Monty Python would say, now for something completely different. I should also say, just at the outset, that I've never sort of written a book or an article, and I've written many, that I didn't feel like I could write differently or better after I'd published it. But if you do that, you'll just write one article over and over again. I know people who have done that, but it wasn't what I wanted to do. My goal in this particular article was to try to begin to get people to think about how the U.S. might reclaim its primary taxing rights, especially over intellectual property income, when the IP is created and developed here, mostly by U.S. multinationals. The big problem is that the current system continues to have shortcomings even after the 2017 legislation, and I don't think we've thought about them quite deeply enough. So here was the problem in 2017. The problem was that the international tax system had become archaic. It was using and still uses rules and concepts that were developed in the 1920s, more than a century ago. And it sometimes seemed to, well, it certainly seemed to allow and often seemed to encourage U.S. multinationals to shift their income to lower tax countries somewhere else. Before the 2017 legislation, this problem was very difficult for Congress to solve, and I never quite understood why, but I think I do now. And that is that with a 35% rate here and zero or near zero rates elsewhere, it was very hard for the U.S. Congress to tell U.S. multinationals that they really had to pay the 35% tax in contexts where they were competing abroad with foreign multinationals that were paying far less. And so we were stuck until 2017. And between 2010 and 2016, a group of economists, mostly at the Commerce Department, said that there was $150 to $200 billion a year that was shifted abroad from 1982 to 2016. 38% of the income of U.S. multinationals, they said, should have been reattributed to U.S. GDP. But the system couldn't be readily changed for the reasons that I've described, but also because the ability to defer income that was abroad and get tax credits when you brought back income, really sort of the system justified the idea that you were going to support the U.S. multinationals. And what's happened over recent years in this field is that multinational tax avoidance, which used to be something that you'd read about, if at all, in the newspapers on the business pages, and that would not be a topic for conversation beyond a group that I used to call the International Tax Priesthood, moved from the business pages to the front pages, and a member of the Australian Treasury who I met said to me that it had become a topic for barbecue conversation in Australia. So that tells you how it mustered its political force. And the idea of international tax moved from the offices, I guess, of the finance ministers and the tax administrators into the offices of presidents and prime ministers. and the political salience of the whole issue changed dramatically. So in 2017, Congress responded, and it responded by lowering the US tax rate to 21% and eliminated the barriers for US companies to repatriate their income back to the United States. It introduced a first global minimum tax called GILTI, for those of us in the business, at around a 13% rate, scheduled to increase to 16.4, but that seems unlikely today. It provided special rules under something called FDII, or FDII if you prefer, which allows a low rate, also around 13% now, on IP that is here that is used in goods and services abroad, to put it simply, and was intended to encourage US multinationals. Some did this to bring their IP back to the United States, but many did not. Then the OECD came in with what it called its two-pillar project. I'm going to skip over pillar one because everyone I know says it's dying or dead, and so I'll spare you that. But pillar two, which is neither dying nor dead, is designed to create a 15% minimum tax on income of multinationals around the world. And more than 70 countries have adopted this minimum tax. And most of the 70, I think, are found in Europe and the Asia Pacific, for those that are thinking about US trading and investment relationships. The three big countries that have not done it are India, China, and the United States. And the United States has been very opposed to it of late. And during the Biden administration, the US Treasury supported the Pillar 2 effort. Janet Yellen frequently said that it was designed to stop a race to the bottom among tax rates. But as a result, if you ask where are we today, we're in a position where a US multinational is supposed to be taxed under US law at 21%, but many obviously managed to go below that, probably due to your efforts in part. And the rest of the world is collecting a 15% tax. And I don't think we've thought about how that changes or how substantially that changes the way we ought to think about international tax rules. And so while the big question looking backwards was, in part about the competitiveness of US multinationals, the big question going forward is which country is going to get the money from the multinationals? Where is the revenue going to go? Under the status quo, with no Pillar 2 conformity here, a lot of the money that I believe the US should be claiming for itself is going to go abroad. And so that's the problem. And given declining labor force participation and aging populations everywhere, everybody needs and wants the money, which is also a change from the post-war era. And so we're in a position where we're going to need the money, and as everybody in this room knows, Congress is now considering a $4 to $5 trillion addition to the deficits, and we're going to need it more than ever after we get through that exercise. Just to put it in context, our interest payments on the federal debt as a share of our economy are now the highest in the OECD, 6 times higher than Japan's, which has a much higher debt to GDP ratio because they've got a much smaller economy, but we're paying 6 times what they're paying in interest. And China spent less than 1% of its GDP on interest in recent years. So it's the interest on the federal debt that I think we ought to be focused on more than anything else. And the Committee for the Committee for Responsible Budget, I say that because I always trip over the idea of a responsible budget. But the Committee for Responsible Budget estimates that extending the tax cuts of 2017 and adding some of President Trump's campaign proposals would add $1.1 trillion in interest costs, another $250 billion a year over the next decade, and will raise interest costs to 4.6% of GDP. So we're paying about twice as much, or a little over twice as much, in interest as the economy is growing each year. We're spending all of our growth plus on interest. These are the legal changes. The other thing I just want to mention by way of introduction are the economic changes that we're now facing. And the economy, as everybody here knows, is very different than it was in the 1920s. The globalization of trade and investment is important. The role of IP, its ubiquity, its mobility, create a very different economy than any that we've had before, and certainly than what we had when the international tax rules that we now live with were formulated. The most important, in my mind, the most important piece of mobile income is IP income, although others will point to interest income and some others, but IP income, I think, is the one to focus on, especially when the IP is from production and development and management and creation here. And so that's the subject of this rather short, at least for me, article. There are many culprits in the current law. I refer to them as the sins in the title of the article. But the one that I focus on most is the allocation of income from U.S. IP to foreign countries, which continues apace. And one of the reasons for that is that we say that the source of that income depends on where the IP is used and not where it is created or developed. That rule, which I explain in the article and will not go into, was a complete afterthought when the source rules came up in the 1920s. It followed rents, where you're talking about immobile property, and nobody ever thought about it. So the most straightforward way to deal with this would be to tax currently IP income from abroad under what is subpart F of the code. I'm grateful that others mentioned sections that I didn't know, so I can mention a section that maybe some of you are not familiar with. But subpart F basically says that income abroad is taxed currently in the United States, and we allow a foreign tax credit for the foreign taxes paid. It was created in 1962, and in 1962, the House would have taxed IP income that was earned abroad as subpart F income. And in 1993, there was a provision that actually passed both the House and the Senate that would have done that, but it never went into effect and was repealed in the late 1990s. I mean, the other thing we could do, mimicking, I think, the UK and Australia and some others, is to call the IP income over there diverted profits, and then that will remove them from some of the constraints that people feel if you call them actual income. I have no position on that question. But I think there is a question about how to treat foreign taxes, especially when you think about the fact that many countries abroad, particularly in Europe and elsewhere, have what they call IP boxes, and they tax income from IP at much lower than their statutory rates, in the 5 to 10% range, to put it generally. And then I think that, and the article argues that more fundamentally, over time, the U.S. should really consider saying that the source of IP income that is developed and created and, made here should be taxed here. And we should change those source rules. Hard to do, but I think important. And a century of bad rules probably is enough. I guess the other thing to say is that there are great simplifications that would occur. There are rules about allocating R&D expenses under the foreign tax credit. There are questions about whether you're going to grant R&D for research and development abroad and so forth and so on. But the basic point here is that, and this, seems a little unlikely in the current climate, but if Congress gets around to reconsidering the international tax rules in a serious way, it ought to think about this in a much more fundamental and basic way than it has in the past, which has been limited to incremental change. So I have to say I've taught at places with very smart people for many years, and I'll give them things to read, and I know they won't read it. So don't worry about reading this article. It will not offend me if you don't, but at least Tax Notes has made it available to you if you're tempted. Loren.
All right, thank you. That was really good. A good overview. For those of us who have read it, I can confirm. So we have some questions to get into. We don't have a whole lot of time, so I'm going to jump right in. In your article, you note that concepts such as capital export neutrality, capital import neutrality, and capital ownership neutrality should no longer be central to our framing of international tax policy solutions. Arguably, our current international tax framework is a hybrid capital export neutrality, capital import neutrality system, which in your view does not sufficiently deter the offshoring of valuable income-producing IP. What are the limits of these old concepts, and how do your proposals fit into them, or how do they not fit into them?
Okay, so for a word for those of you who are engaged in practice outside of the international tax business, capital export neutrality basically says that you should tax income the same whether it's here or whether it's abroad. It was a concept developed by an economist in the 1960s and has been a very important idea in international tax policy beginning in the 60s, I would say. Capital import neutrality says that two companies from different sovereigns should be taxed the same on the income in wherever they're earning the income in the source. And capital import neutrality is about competitiveness that I described earlier, I think, for those of you who are not deeply into the economics business. They're both worldwide concepts. And I think the first article I ever wrote on international tax, I said at the end that the only way that you can have both of these together at the same time is if all the countries that are involved have exactly the same tax system, the same rates, the same base, and so forth. You can get both of them. But there's an impossibility theorem that says you can get one or the other, but you can't get both unless everybody's got the same tax system. Well, I had a law professor that says that if you believe that everybody's going to have the same tax system, you'll never own your own home. And that's right. And so everything can be a compromise between CIN and CEN. And Congress justifies whatever it does as sort of compromising between these two opposing forces. And I said in this article long ago, so I predate, just to be clear, America First notions, that politicians are going to look at the question of how to improve the well-being of their citizens and residents. And they're going to look at it from the perspective of what's good for their country. And that's the way we ought to start thinking about this, and then we'll negotiate with other countries if need be. And so that was one fundamental reason, which was that we're never going to get both of them, so why do we keep trying to say anything is a compromise? But the other point, which I made before, and I won't repeat it, is that it was very hard to say that we weren't going to let U.S. multinationals compete abroad by taxing them at 35% when they could get 0 or 5 or 15 or 12.5 abroad. And so these are, in my mind, they're archaic and not very useful, I suppose is the way I would put it.
Okay. And to follow up on your observation that politicians are going to do what's in the best interest of their constituents, in the paper you assert that Congress should address international tax issues from the perspective of our nation's welfare, the best interests of U.S. citizens and residents. So we are currently in the midst of some tax legislation in which retaliatory measures have gotten a bit of airplay. Why aren't these an effective means of putting America first?
All right, well, let me say two things about this. One is, there's been a lot of discussion that the OECD and its pillar projects, 2 pillar projects, I guess after Sampson, is an infringement on U.S. sovereignty. And nothing in these 2 pillars stops the U.S. from doing whatever it wants. They require unilateral action, and especially the 2 pillar project. And so Congress, and particularly the Republicans in Congress, have been expressing how the OECD and international organizations are threatening U.S. sovereignty. Now, I wouldn't say this to them, but I'll say it to you. If Congress is really worried about its sovereignty, all it needs to do is look up 16 blocks to 1600 Pennsylvania Avenue and not look across the Atlantic or the Pacific for threats to its own sovereignty. But that's my view. So the sovereignty argument, I think, is a red herring. On retaliation, so income tax is really a tiny tail. I know for us it's the whole dog, but it's a tiny tail on the tax dog, and it's particularly a tiny tail on the issues of the Western alliance and compared to trade and investment flows. And so we're in a moment where the US government is in a retaliatory mood. And we're retaliating, we're talking about retaliating through tariffs for offenses that the current administration sees in the trade context. We're talking about all sorts of other foreign policy issues in the global context. And I just think it's important to recognize that the Biden administration, and here I'm talking about the National Security Advisor, the State Department, Commerce, and the Treasury, the Secretary of the Treasury, really thought that the Pillar Project was a way to rebuild the Western economic alliance, which they thought had been shaken a bit from the previous administration. And now we're in a very shaky situation. And the idea that we should come up with some income tax retaliation rules for something that's going on because of the minimum tax that's being imposed strikes me as taking a very narrow lens to a very big problem. And the last thing the Western Alliance needs, in my view, is a new place to fight about retaliation. So I argue very strongly in this piece that it's the wrong moment and the wrong answer if you're going to think about we should retaliate because they're putting a minimum tax on money earned in their countries by U.S. companies.
All right, thank you. Well, we'll see more, right? There's certainly, the chairman of Ways and Means has a retaliatory measure that he has introduced. We'll see if it makes it into legislation that's set to be marked up.
Well, the Ways and Means Committee is important to say, for those of you who are not following this game, the House Republicans have a new retaliatory measure. There's some retaliatory pieces in the Internal Revenue Code that nobody will use because they're too blunderbuss and they don't work. But there's a new one.
Right.
It's a little less blunderbuss, but I don't think it's going to work. But maybe it will. But we won't get into that here because I think the basic idea of using retaliation in this context is a mistake.
Yeah. Okay, let's move on. A cornerstone of your paper is advocating for a revamping of our current sourcing rules, specifically that income generated from U.S. developed IP should be sourced to the United States. Are there compelling reasons why we might want to maintain status quo with respect to the sourcing rules as characterized in our double tax treaties? In other words, should we instead reimagine in what circumstances we might want to cede primary taxing rights and in which circumstances we might not?
Well, when I served in the Treasury, we treated tax treaties as if they were really very important. Even though I was reminded then and again this morning about a comment that the Chief of Staff of the Joint Committee made during the 80s when he was involved in legislation overriding tax treaties around the world. And he said, when I talked to these people who negotiated these treaties, you'd think it was Dutch, referring to Ronald Reagan, and Gorby, referring to Gorbachev, in Reykjavik, negotiating over nuclear bombs. And the point was that the issues that are at stake, I think, in tax treaties are fairly low stakes these days. And so my attitude about the tax treaties has really changed over time. I think that in the first place, we have 2,000, I think, bilateral tax treaties. They're all, the whole arrangement from the 1920s was bilateral instead of multilateral. They're bilateral treaties around the world. They all lose revenue. Let's start with that. None of them raise any revenue. They were negotiated by people who are enamored of CEN and CIN, which we've talked about. They were very important in developing an international tax system from the early 1920s through 2010 maybe. I don't know when they became less important. But they don't deal very effectively with source rules. People really are now saying, well, this is our money, and they're doing it unilaterally. They deal with withholding taxes, which you could do in a much simpler document. And they deal with administrative dispute resolution and exchange of information, which the government has done for years in very short, not terribly technical documents. And so I think the treaty process has broken down, and I think the OECD's efforts, beginning with its first projects at the early part of the 21st century through the two-pillar project, is just evidence that the treaty process is not really fit for purpose today. But I know others, including you, feel differently.
I still feel strongly about reserving treaties, but I take your point. Of course, we can observe many instances in which countries are imposing tax rules that fly in the face of treaties that they have negotiated with us and other countries. And so I think the question becomes, do we work to preserve what's in treaties, or do we cede to the reality of today and find some other way to move forward?
So I think this is a great question. I hear rumors, it's probably in the press somewhere, but I didn't see it, that the U.S. is thinking about negotiating a tax treaty with China. My view about that is, how are you kidding yourself? I mean, you have a tax treaty with China, and what do you think China's going to do? Well, it owns most of the enterprises in China, so it'll just do what it wants. The ones it doesn't own, it will influence either through subsidies or limitations. And when you bring your IP into China, it will either take it or require you to give it to them. And so what's a tax treaty going to do in terms of stopping China from doing whatever it wants in this field? I wish I could be more optimistic about that, but the last thing I would do if I were back at the Treasury is start tax treaty negotiations with China. I don't know how many dolls that would involve, but I'm not for it.
And so instead, do you think it would make more sense to have a scaled-back treaty network, mainly for double tax case resolution, looks more like our TIEA?
I do. I mean, I think it's important. I think rethinking dispute resolution procedures and arbitration and multilateral negotiations, which are often important, is very important. We ought to think about that anew. Mm-hmm. and that, dispute resolutions need to be solved out of court and, bilaterally or multilaterally, so that's very important. And information exchange is obviously important, but information is coming and information is going to be public. I guess the other thing to say is that, there's reporting rules that are going on now in Europe and elsewhere that are going to make the international tax policy avoidance conversation much more salient than it has been over the last decade, because there's going to be a lot of facts. And my guess, it's just a guess because I don't do this work, is that some of the facts are not going to be terribly pretty for the multinational community.
All right, let's get back to sourcing. So you assert that resourcing IP income to the country where it's been created or looking through to where IP has been principally developed to determine source is the proper approach. This sounds a lot like value creation concepts. What are you thinking when you're making these statements? Is that an endorsement or maybe a suggestion that we should enlarge or narrow that concept?
So the OECD in its first project, which was very incremental, the BEPS project as it's called, base erosion and profit shifting for those of you not in the lingo, it stuck very close to existing knitting in the international tax area. And it's gotten away from that now. And, and then the question is, what are we going to do? How are we going to get IP back to the U.S.? And my understanding is that after the 2017 Act, you had a minimum tax on income abroad, the GILTI provision. You had a subsidy or a lower rate of tax, if you prefer, on IP income that's used abroad. And a number of big companies brought their IP back to the United States in some fundamental way, but a number did not. A number went from Bermuda to Ireland, for example. I won't name names, but you could probably figure out who they are. That's public information. And if you look at the Irish tax receipts and the Irish GDP, these companies are very obvious. They're U.S. multinationals that are contributing way more than their share of tax revenue to Ireland and way more than their share of IP to Irish GDP. So it's a start. And the question that I was really addressing in the article is, having started there, where should we go? There were proposals in the Biden administration to raise the rate on corporations and raise the rate on FDII. And I think that the FDII rate should stay below 15% or right at 15%, so it's competitive with all of the rates elsewhere, a little under maybe. And I hope it will be more effective. I think there are reasons why the IP doesn't come back, which I will not get into in some cases, but we really have to think about it. And then, as you point out, I say, well, if that doesn't work, let's just claim it and say it's our income and, your move. We're going to tax it, and then we'll talk about foreign tax credits for it, or we'll discuss how much of it you get, and if you've got a market country, we'll negotiate about that. But it should be sourced here. It was developed here. It was created here. It's ours, and it should have been sourced here. If it was important, it would have been sourced here, the same way that interest income was sourced to the capital exporters when the UK and the US were negotiating the first tax treaties in the 1920s. It's just that was important then, this is important now.
And what about, I can see that world where we say, all right, it's ours, it's sourced here because it was created here. But we also have had years of arguments of, contribution to value by virtue of the size of the market.
Sure, value creation.
Yes, yeah.
I'm sorry, I missed that.
That's okay.
You said it, but I missed the value creation point. So OECD in its first effort said we're going to decide where income belongs by where the value is created. Okay, Well, the value is created by everything that goes into creating the value. And so then the question is, how much did each element contribute to that value? And I would argue that what I'm urging, which is that the U.S. claim its source basis for taxing income that is essentially created here, is a value creation method. It's just weighting very heavily where the IP is developed and created and managed and so forth. So I think it's within the context of value creation, but the value creation, like formulary divisions of income, is just not a solution. It's what's the next question?
It's a concept. So we start with 100 and then decide how much.
We get 100 and who
back.
gets how much of it. But I think that we should be getting a lot more than we are. I guess that's my value creation comment.
Okay, I think we have 4 minutes left. I want to leave you time for your concluding remarks. So maybe one question. You touched on repatriation of IP after 2017. And the White House recently publicized its priorities for the upcoming tax bill, among them a reduced FDII rate, for at least for the next 4 years, so 25 to 2029. And in your article, you noted that as a part of the expansion of Subpart F to include foreign source income generated by U.S. developed IP, it may be appropriate to have a new separate limitation basket for IP income or low-taxed income more generally to further encourage the repatriation. Why do you think that the combination of GILTI and FDII fell short in encouraging U.S. MNEs to repatriate IP, or will continue to fall short even with a lower FDII rate?
Well, I mean, why do I think it fell short is because it fell short. That is, big companies didn't repatriate, even though some did. So this is just what my 4-year-old grandson would say is just the way it is.
So the concepts
there remain
don't work.
incentives.
Yeah.
So let me just say one thing. The Pillar 2 project assumes that if you only average income per country instead of averaging it worldwide as we do under our system, you're going to stop a lot of this problem. But if you look at per country tax systems, they have 2 different tax systems. They have low rates on IP and they have normal rates on other income. And so the averaging intercountry will also continue with all of these rules, even with Pillar 2. I don't think that's a silver bullet in the way that a lot of people in the international community do. So I think it's going to continue, and they're clearly, you move your IP from a place where it's not going to be taxed when it's sold, and you get a new basis that you can amortize over a number of years in another relatively low tax country. There are lots of opportunities for continuing to shift IP abroad, and they're often advantageous. And I guess what I'm saying about the foreign tax credit is we really ought to think seriously about saying if it's low taxed IP income and it's taxed at 5%, deduct it instead of getting a credit for it or something. I mean, if we're going to, I think Congress was talking until this week about repealing the state tax deduction. For corporations. Well, if you're going to repeal the state tax deduction, you really need to rethink the foreign tax credit, which we haven't done at all. But that's sort of where I ended up on that one.
Okay, good. All right, well, I will turn it back to you for some closing thoughts.
Well, I've given you most of my thoughts, but I really want to put this in a broader context and return to the question about interest on the federal debt and the budget situation. So our interest on the federal debt now, as I said earlier, is hitting 4.1% of GDP, even if the tax cuts that are about to be extended were not going to be extended. So it's going to go up. And the CBO estimated recently that if you get a 1 percentage point increase in the interest rate from the ceiling of 4.1%, that 3 decades from now, the interest will cost $11 trillion a year. And the question I keep asking, and nobody has a good answer to it, including me, is how can this happen without stimulating a fiscal crisis, stymieing economic growth, inhibiting our ability to provide for the American people, and especially when 30 to 35% of every dollar of interest is going abroad. And so we really need to get our budget in order. And as it did in the past in the Clinton administration and the George Herbert Walker Bush administration, the only way to do that is a serious combination of additional revenues and spending cuts. But the current Congress and administration seem determined to spend $5 trillion or more, and then just to do it in a way that's a deceptive paint-by-numbers exercise that disguises the cost of it from the American public. And so that's where we are. I'd like to leave, I know I've got 1 minute or 30 seconds, but I would like to leave you with something useful. I was giving a talk on my most recent book at UCLA, and somebody in the audience stood up and said, well, we're saving all this money, we just saved $50 billion on USAID. It was right after Musk had cut the USAID program. And so I thought I needed to come up with a way to leave you with something you can actually use that will explain the federal budget to a lawyer, and particularly the difference between millions and billions and trillions, all of which unfortunately rhyme. So here's the way I explained it. If a lawyer earns $1 a second, he or she will earn $3,600 an hour, not bad. At 2,500 billable hours a year, that's $9 million a year. To earn $50 billion, which was the USAID number, the lawyer would only have to work 1,585 years. But to earn 5 trillion, 50 sounds more than 5, to earn 5 trillion and pay for the tax extensions, the lawyer would have to work 158,500 years.
Thank you.
Thank you so much for this wonderful discussion, and really read the article. It's terrific. And so with that, we are at the end of our program. We look forward to the virtual 2025 fall meeting, and we hope to see you again in person in San Diego at the mid-year meeting in January. Thank you very much. Have a great Mother's Day tomorrow and a safe travels home. Thank you.